today for the presentation of the OECD's Economic Outlook for Southeast Asia and the World Economy. Before we get started, I'd like to mention that we will have a question and answer session following the presentation. If you have a question that you would like one of our experts to respond to, please add it into the chat. Today's event will be structured into 4 parts. The global outlook will be presented by our chief economist, Alvaro Pereira. The regional outlook for Southeast Asia will be presented by Jens Arnold, the head of our Southeast Asia division. Then that will be followed by individual presentations of Indonesia, Malaysia, the Philippines, Thailand, and Vietnam by Cyril Schwellis and Phil Hemmings, as well as Jens Arnold. Now, I'd like to turn the microphone over to Alvaro Pereira.
Thank you very much, Laura. Hello, everyone. A pleasure being here to present the latest OECD economic outlook, in particular with a particular emphasis to Southeast Asia. Next slide, please. So what have we seen right now is basically, and the overarching topic for our presentation is that there's been a significant increase in uncertainty in the past few months in terms of economic policy uncertainty, in terms of trade uncertainty, and as a consequence, growth has been, downgraded quite substantially. So if you look at consumer confidence, if you look at business confidence, if you look at activity indicators like you see here, there's been a significant decrease in all these variables for most countries. So the countries more affected are usually the ones that have been also more impacted by tariffs. And so that's not surprising that in activity indicators you have Canada, Mexico, and the United States highly affected, but also the same thing in other countries for Spain or Japan and China as well, even though to a lower degree. Next slide, please. One of the reasons why we have this huge uncertainty is basically first the substantial change in trade policy from the United States. And in this chart, you can see the average effective tariff rate for the United States since 1890, so in the last 130 years. And what you can see is that the different dates are when the announcements happen. But you can see in the chart that right now our assumption is that the May 14th tariffs, that means the 10%, stay for everyone. And hopefully there'll be negotiations for the other tariffs to be removed. But we are assuming the 10%, 25% on steel, 25% on cars, and 30% on China at the time. Of course, the following announcements led to a significant increase in the average tariff. So April 9th announcements, we had tariffs that were as high as in 1890 for the United States. If we assume the May 14th, then of course we are still talking about tariffs that are as high as they were in 1936. Of course, because today's announcement of that the 50% tariff on steel and aluminum came into being, we didn't incorporate this in our forecast because at the time when we finished the forecast, this was not on the table. Next slide, please. Having said that, in spite of all this uncertainty and so on, trade in the first quarter of 2025 has held up quite well, and partly it has been a big front-loading of exporters to the United States in terms of steel, aluminum, and pharmaceuticals, and that's why you can see in this chart the last quarter was the best that we've seen in terms of trade growth in the last 4 years. But we expect there'll be corrections going forward, even though likely in the next 1 or 2 months, it's possible because of the suspension of tariffs of the United States vis-a-vis China, it's possible that trade will still be more dynamic than we had feared. Next slide. So next slide is about our forecasts. I think we lost the slides. Well, the forecast that we have for the world economy is 2.9% for this year and the next. We're talking about a significant reduction in terms of forecast. We've downgraded almost everybody. Next slide, please. We downgraded almost everybody. So you see a lot of red in our forecasts, both for the G20, but also for the non-G20. We downgraded significantly growth for the United States from 2.2 to 1.6% this year and 1.5% next year. But also for countries like China, also downgraded to 4.7 this year and 4.3 in next year. And we'll talk about more the region a bit later on. But basically, what matters, next slide, is the sea of red. It doesn't matter if you're a G20 economy, non-G20 economy, if you're a large economy, a small economy, everybody, or almost everybody, has been downgraded from our forecast. Next slide. Inflation, also we forecasted that inflation will stay higher for a bit longer because of the inflationary pressures associated with the tariffs and also all the uncertainty. But we still expect that by next year, inflation will be close to target for most countries. Next slide, please. So, what are the risks that we see going forward? First, there's the risk that there will be further trade fragmentation, and this will have an impact on growth. So, in this, we have a simulation of that the 10% tariffs that exist, if they have an additional 10% tariffs of the United States vis-a-vis other countries, basically, let's put it this way, it's like as if we are assuming that 10% reciprocal tariffs will be applied to everybody. What's the impact? Well, there's a direct impact, what you can see in the red column, in the tariff changes for the United States, the world, and non-OECD and OECD countries. And then there is an indirect effect by the increase in precautionary household savings, which is the green part, and worsening financial conditions in the orange part. There is a slight positive impact by weaker commodity prices, but you can see for the United States, a 10% increase in tariffs vis-a-vis everybody would lead to, after 2 years, 1.6% less growth. For the world, about 1.1, 1.2% less growth. And so obviously this will impact also the region. Next slide, please. Another risk that we think that is important is on inflation. We don't have a graph here, but inflation that might be stickier than expected. In fact, we think that this is fairly possible because service price inflation has been sticky and good price inflation has ticked up. With the inflationary pressures, it's possible that inflation will go up before it comes down in some countries. And another risk is exactly what you see in this graph, which is aging pressures. But in particular, we think there is significant fiscal pressures and fiscal challenges for many countries. Debt levels are unprecedented for peacetime, so most countries of the world. We have now defense expenditures pressures. We have the pressures to spend more on the green transition, particularly on energy security, and also pressures on aging costs, which you see here. And for many countries of the region, we know that this is an issue. Well, even though if it's not an issue, it will be an issue very soon, because many countries of the region will be aging like it happens in other countries. And this means that unless you have good pension reforms and an excellent health system, you'll be fairly impacted. And here you have several countries we expect that there'll be 5, 6, 7, 8% additional costs for aging costs. And this will only add to the fiscal pressures going forward. Next slide. Another risk is on tighter financial conditions. In particular, many low-income countries have to, like many others, have to refinance their debts. But the most important part is what you can see on the right-hand side is that 40% of this debt that has to be refinanced in the next 2 years is from highly speculative categories. So it's possible that many of these countries will have problems refinancing their debts. Next slide. And another issue that we have been concerned is that there's been historical valuations in terms of the equity markets in some countries. And it's possible if there is a negative shock or continues to have a negative shock in the economy, a surprise one might bring more vulnerability, and more volatility to equity markets with potential corrections going forward. Next slide. In terms of policies, first of all, we think that the most important part in terms of top policy priority should be lower trade barriers to boost global growth. In particular, we think that countries should get to the table and try to get an arrangement to an agreement to decrease um, trade barriers and tariffs. This graph basically tells you our forecast for trade growth in December and now. You can see it's a big gap. And likely, if, of course, if there's more tariffs along the way and if there's retaliation from other countries, it's very possible that trade growth will be harmed even further. So it's a huge issue. And remember, trade has been one of the great engines of the world in the past few decades. More than 1 billion people got out of poverty because of trade all across the world. And so when you have less trade, you have less jobs, you have less growth, and you also likely have more expensive products, so more inflation. Next slide. Other policy that we think it is important is in terms of monetary policy. Of course, monetary policy will be, it depends really on, next slide, please. It depends on the country. For the United States, for example, we expect because inflation will get close to 4% by the end of the year. We don't expect a lot of changes. In fact, we don't expect any change in policy rates this year for the United States. We expect them next year. A bit lower in Europe, but in Japan, we expect that policy rates will continue to gradually go up since inflation continues to be higher than the target, and we expect that this will likely lead to an increase in the policy rate. But many other countries, the most important thing that monetary policy has to remain vigilant and data dependent. Next slide. And finally, on fiscal, we think that what is key is fiscal discipline. This graph basically tells you what is for the average OECD country. Where are the average OECD country? Where is the spending? There's several areas. It could be security, it could be education, it could be aging, it could be health, it could be many other areas. But what matters, we think that in order to have fiscal discipline, you need to do several steps, if possible, to bring fiscal discipline. First, you should have, if possible, medium-term fiscal frameworks so that you know how to plan and expect for eventual negative shocks. You should also undertake periodic spending reviews so that you are in all the areas of virtually all areas to try to bring efficiencies and decrease expenditures when possible. And also, for many countries, we think that changing the tax mix to have more growth-friendly taxes, but also broadening tax bases is going to be important to bring more fiscal discipline. I won't talk about it, but we get in the Q&A if there's any question. Our special attention this year in the economic outlook is about investment. Can you boost investment? And we look at several areas from housing to public investment to business investment, and we try to understand what needs to be done to boost investment. And with that, I would pass the word to Jens.
Next, we have Jens Arnold, who will present the regional outlook for Southeast Asia.
Okay, thank you very much, Laura, and thank you very much, Alvaro. Allow me now to dig in a little deeper into the regional dynamics in Southeast Asia, more specifically the 5 economies that are covered in our economic outlook and on which we also prepare our in-depth country reports, which we call the OECD economic surveys. And these countries include Indonesia, Malaysia, the Philippines, Thailand, and Vietnam. So as we see on this slide here with our growth projections for those 5 economies, so far growth in Southeast Asia has been fairly strong. During 2024, the 5 Southeast Asian economies that we cover grew at a weighted average of 5.0%, and that's considerably stronger than growth in the OECD area. And in fact, it's on par with growth in China. And yet, for Southeast Asia, 2025 will likely be a very challenging year. In fact, our growth projections for 2025 will fall short of what we saw in 2024 in all of those 5 Southeast Asian economies. And the same pattern is, by the way, as Alvaro mentioned, projected for both the OECD and also for China. In Southeast Asia, we then expect a slight rebound of growth in 2026. Now, what is clear is that tariffs and the policy uncertainty that we're seeing are likely to dent trade and investment, and that will be enough to take some kind of toll on overall growth. Some of the most recent purchasing manager indices, in fact, already give early indications of slowing activity. Next slide, please. So many countries in the region have, of course, built their remarkable economic progress on exports, and they are tightly integrated into global value chains. Exports are a sizable part of GDP in the region, as we see here in this chart, and probably few other regions in the world are as exposed to the projected slowdown in international trade as Southeast Asia. Within the region, however, we also see differences. Countries that have a larger domestic economy tend to be more insulated than others. And this is the case, for example, for Indonesia and the Philippines, where domestic final demand is around 70 to 80% of GDP. But the opposite holds for Vietnam, where gross exports cover more than 80% of GDP. Next slide, please. In fact, a more precise measure to look at the exposure, at least to what's happening in the US market, is the domestic value added in exports to the United States. And on this chart, we see that more than 8% of Vietnam's GDP is directly derived from such exports. So if those were, for example, to decline by a quarter, then GDP growth would be down by 2%. In other words, many people's livelihoods are directly or indirectly tied to these exports. Next slide, please. So trade will likely be less of a driver for growth moving forward, but that may in fact not be the only channel through which trade uncertainty affects growth. Many countries in the region have attracted sizable inflows of foreign direct investment, most of which into export-oriented activities. In other words, investment could also be affected, not only trade. Next slide. So what can policymakers in the region do to face these challenges? Of course, macroeconomic policies will be able to play a role to cushion part of the impact in the short run. As economies face these shocks, policymakers are going to look at how much policy space they have to make up for the slowdown in trade, setting the stage for monetary and fiscal easing. Now, the good news is inflation is generally low and well contained in the region, which is a precondition for monetary policy to provide support. But monetary easing will have different degrees of powers across Southeast Asia, and transmission into lending rates and credit volumes will be different across countries. In Indonesia, for example, fiscal and external concerns have led to volatility in the rupiah exchange rate, which has complicated to some extent the central bank's easing cycle. In fact, the monetary transmission into retail borrowing rates has been smallish in Indonesia, with 50% basis point cuts in the policy rate translating into only 11 basis points of reductions in commercial lending rates. In Thailand, the transmission of monetary easing could be hampered by the high levels of household debt, making banks more reluctant to lend more. Similarly to Indonesia, recent rate cuts have also led to relatively small effects on lending rates, even for the most creditworthy borrowers. Next slide. So fiscal policy can also help, but the fiscal space available for that depends very much on the individual economy. High fiscal deficits are limiting the available fiscal space in many economies, for example, in the Philippines or in Malaysia. The effectiveness of fiscal stimulus, what we economists call the fiscal multipliers, also depend on the specific situation of each country. In Indonesia and the Philippines, for example, multipliers are likely to be higher as households consume large fractions of additional disposable incomes, and much of that extra consumption is likely to be spent on domestically produced goods and services. Thailand's recent experience is different. It spent 0.9% of GDP on the first two phases of the digital wallet scheme, but the consumption impact of that was pretty small, providing only a marginal boost to growth. Next slide. The levels of debt can also limit the available fiscal space. At almost 65% of GDP, debt is highest in Malaysia. Countries in the region have often low debt levels when we compare them to OECD economies, but we should also bear in mind that they raise much lower revenues relative to their GDP and are often more exposed to external risks. And on the next slide, allow me to come back on the issue of population aging that Alvaro already mentioned. I think it's important to consider one thing that all countries in the region have in common. There's a need to build additional fiscal space in the face of rising long-term spending pressures from population aging. And at the same time, there's a need for strengthening social protection systems and for the large investment needs that will arise in the context of climate change mitigation and adaptation activities. Next slide. So when it comes to policy support that can be directed to ease the current patch of weak growth, I think it's important to also keep in mind structural policies. This is probably the most powerful policy areas where countries can take action to address the current challenges. Opening up markets to competition can be a key driver for productivity. For example, regulatory policies, especially those pertaining to licenses and administrative burdens for new entrants and including foreign entrants, often play a key role in this area. The OECD policy indicators offer a deep dive into these kinds of regulations, like this indicator here that shows how restrictive economies are to incoming FDI. Here we see that the 5 Southeast Asian countries are more restrictive than many other economies. Now, this high level of restrictions may be counterintuitive at first sight, given that these economies have attracted so much FDI. But in fact, what we see is that many of the Southeast Asian countries combine a relative openness when it comes to goods with higher restrictions and lower levels of competition in services sectors. So reducing barriers to FDI and services would be one avenue to improve the competitiveness of domestic producers. Next slide, please. So improving the supply of skills through better education and training policies can also play a key role for improving competitiveness. Where a better skilled workforce allows local firms to meet the high quality standards of foreign affiliates, there will be more supplier linkages with FDI firms and more spillovers from their often superior productivity to the wider economy. Training, and even beyond the regular school curriculum, should be accessible to many workers and be well aligned with the needs of the labor market. Finally, and this brings me to the next slide, labor markets and social policies can also play an important role. Large parts and often the majority of the labor force works in informal employment in the region, which reduces firms' incentives to invest in their workforce through training. From a social perspective, it leaves many workers without access to social protection benefits. Pension coverage in Malaysia, for example, is below 20% and around 30% in Indonesia. Building on existing non-contributory social benefit schemes can often provide an avenue for expanding coverage without raising social contributions, as high contributions can raise the cost of formal job creation and keep more people trapped in informal employment. So with these considerations on the region, let us now dive deeper into the economic perspectives of individual Southeast Asian economies.
Now we have Cyril Schwellnus, who will discuss Indonesia.
Thank you, Laura, and hi, everybody. So I'm going to dive into more detail on the Indonesian growth outlook. So what we see in Indonesia is that consumer demand, as in many other Southeast Asian countries, remains remarkably strong, with household consumption in the first quarter growing by 4.9%, which is fairly high. But on the other hand, we see that there's more caution in capital formation, with investment growth decelerating as businesses assess uncertain market conditions. Government consumption also contracted in the first quarter of 2025, which reflects cuts by the government to finance priority projects, such as the free meals program and the creation of the Danantara Sovereign Wealth Fund. Exports, as Jens showed before, remained relatively strong in the first quarter, but we anticipate some moderation on the back of heightened global trade uncertainties and softer commodity demand. So overall, on growth, on GDP growth, we forecast 4.7% for 2025 with a slight acceleration in 2026 as trade conditions and domestic conditions stabilize. On the inflation front, price pressures have moderated significantly. So headline inflation even temporarily fell below the central bank's target band at the beginning of the year, but that reflected temporary factors, especially an electricity price discount at the beginning of the year in January and February. Looking forward, we anticipate that inflation will gradually return to our target levels, reaching approximately 3% by 2026 as temporary factors fade and food and energy prices stabilize. So overall, we see some room for the central bank to provide additional monetary accommodation to support economic growth, which has been relatively weak, and we expect to remain weaker than usual over the next quarters. Now, looking even further ahead to the medium term, we identify two critical areas where structural policies could significantly boost economic efficiency and living standards. One, as Jens already highlighted in the overall Southeast Asian presentation, is foreign investment liberalization. Recent reforms have made some progress in this area, but there remain substantial opportunities to attract more international capital and expertise. So removing remaining barriers to foreign equity ownership, particularly in telecoms and transportation, will enhance competition, drive innovation, and accelerate economic modernization. A second priority that we see is to improve public spending efficiency. This includes better targeting of social programs. And what we mean by better targeting is better targeting these programs to vulnerable people. For instance, the free meals program, we see that as a positive step to strengthen public health outcomes. So it's an important program that we support, but we think that enhanced targeting to focus resources on the most vulnerable households would maximize impact while ensuring fiscal sustainability. Thank you, Laura.
Thank you, Cyril. Now we will have Jens Arnold, who will present Malaysia.
Okay, let's see if we can get the slide. In any case, in Malaysia, we saw remarkably strong growth of 5.1% in 2024, and that was largely driven by consumption and to a lesser extent also by investment. And after a small contraction at the end of 2024, GDP growth rebounded, and we now expect 3.8% of growth for 2025. And there we see the slide, hopefully. Next one, please, Malaysia. Okay, so we expect a 3.8% growth for 2025 for Malaysia, followed by an acceleration to 4.1% in 2026. Exports were strong in 2024, and we expect that to weaken somewhat going forward. Now, the labor market has been remarkably strong and is expected to support private consumption going forward. Unemployment is at a 10-year low, while labor force participation is rising steadily. Inflation has been low and is expected to rise only very slightly to 2.2% in 2025, rising further to 2.7% in 2026. The monetary policy stance is considered broadly neutral, and that is rightly expected to continue like that, although there would be some scope for monetary easing if growth were to weaken. Now, on the other hand, monetary authorities should, of course, remain vigilant to price pressures that may potentially arise from the tight labor market and from increases in the minimum wage and in civil servants' salaries. In terms of structural policy priorities, we would like to highlight further measures to reduce gender employment gaps and allow more women to participate in the labor market, for example, by investing into child care support. In addition, the tight labor market is also characterized by significant skill mismatches, so investing more into adult education could boost growth and at the same time social inclusion. And with that, we're hopefully back to the slide. A few further down. Wonderful. Okay. Over to the Philippines.
Thank you, Jens. Now we'll have Cyril discussing the Philippines.
Okay, so over to the Philippines. So in the Philippines, we see the growth momentum to be broadly stable. Okay, so consumer spending, as in Indonesia, as in many other Southeast Asian countries, also drives economic growth here. So it's a main driver of growth, and that is underpinned by a robust labor market, where unemployment has stayed below 4% over the past months. Government spending has also been pretty strong recently, especially in the first quarter, ahead of the midterm elections. So that has also supported growth. But investment is going through a soft patch, growing well below its average over the past 3 years. Exports, again, are growing at a healthy pace, but we expect that to weaken on the back of escalating global trade tensions. Even though as we've seen in Jens's presentation, that the Philippines is less exposed to a slowing of global trade than many other Southeast Asian economies, because growth is mainly driven by domestic demand. So the bottom line is that we project steady growth of 5.6% in 2025, and then a slight acceleration to 6% for 2026. On the inflation front, price pressures have moderated. So headline inflation has come down to 1.4% in April, which is below the central bank's target range of 2 to 4%. And that decline reflects in part declines in food and energy costs, but also moderation in core inflation. So, inflation excluding food and energy, which is now close to the lower bound of the central bank's target as well. So looking ahead, we expect inflation to gradually return to 3% as food prices stabilize and monetary policy continues to ease. Now, looking further ahead to the medium-term growth prospects, we see significant scope for policy reforms to boost productivity and living standards. So here we have identified 2 critical areas. One is barriers to entry and competition, especially in electricity and telecommunications. Electricity prices are very high in the Philippines, so strengthening competition would likely help to bring down prices. And all that would actually help lower costs for businesses and consumers while encouraging private sector investment. A second priority we see is non-wage labor costs. So these should be brought down, and that could be done, for instance, by shifting some of the social contributions that are currently financing health insurance to general taxation. We also see some room for employment regulations to be updated to make it easier for businesses to create formal jobs. All this would expand opportunities for workers while strengthening the foundations of economic growth. Thank you.
Thank you, Cyril. Next up, we have Thailand with Phil Hemmings.
Hello. In Thailand, we're very much seeing the impacts of this new tariff environment. What we've highlighted here in the slide is the surge in exports. We've seen a rapid increase in the nominal value of exports in recent months. This has been confirmed in the first quarter of national accounts, where we saw robust volume export growth. However, the national accounts also indicated a fall in imports and also a fall in investment. And we think these are also two signs of a reaction to the new tariff environment, with producers potentially cutting back on their production plans. More broadly, we are seeing, perhaps as expected, a deterioration in consumer and business confidence. As I think other presenters have underscored, in the area, inflation has generally been low, and this is indeed the case for Thailand. And in fact, inflation has only just really risen to being just above the lower bound of the target band of 1 to 3%. So, as is the case for some other economies, there has been room for the central bank to support the economy, and this is indeed what it has been doing. It has made 3 rate cuts in recent months. The latest was in April, bringing the rate to 1.75%. In terms of policy priorities in the years ahead, I think the 2 things we'd like to emphasize. Firstly, in the coming years, Thailand really needs to look forward to mobilizing additional fiscal revenues. As I think Jens underscored, emerging market economies tend to have a small share of revenues as a share of GDP, and also the same is true of spending, of course. But over time, as these economies develop further, one would expect these shares to rise. Thailand needs to mobilize more revenues for 2 reasons. Firstly, because the public debt is heading towards the 70% ceiling set by the Thai authorities. And as underscored by Jens, although these levels of public debt burden are not terribly high compared with many OECD countries, they are relatively high for emerging market economies. So it's important to bring that public debt burden down. The second reason that Thailand needs to mobilize additional revenues is to enable a further expansion of social protection and pensions and healthcare as its economy develops further, and also due to Thailand's fairly rapidly aging population. The second policy priority I would underscore is Thailand's need to raise growth potential. Thailand, in particular, through increased labor productivity. Thailand's labor productivity growth between 2010 and 2015 was 4.8%. It was only 2.6% between 2015 and 2022. So there's certainly room for it to strengthen that productivity growth. And this needs to be done through several channels, but one very important channel, and I think also underscored by Jens, is for Thailand to try and strengthen the degree of competition between businesses operating in Thailand, so that they are more incentivized to innovate, to compete on price, and to improve the quality of goods and services that they provide. Thank you.
Thank you, Phil. Now we have Jens Arnold, who will be discussing Vietnam.
Okay, so in Vietnam, we've seen a really remarkable growth of 7.1% in 2024, and we project this growth to remain strong at 6.2% in 2025 and 6.0% in 2026 in our central scenario. However, as mentioned in the discussion of regional challenges, Vietnam's economy is very open and is particularly exposed to international trade, in particular to demand from the United States. Potential tariffs in the US are therefore undoubtedly a significant risk to growth in Vietnam, as over 8% of its GDP is directly derived from US exports. Now, given the current policy uncertainty, exports are expected to weaken, with significant uncertainty, we must admit, around the magnitude of this decline. Private consumption is expected to remain buoyant, and favorable market conditions will be supporting this, including low unemployment, a rising labor force participation, and very vigorous wage growth. In the absence of major external shocks, inflation is expected to rise slightly amid strong domestic demand, including strong public investment. The current accommodative monetary stance is expected to continue, but monetary authorities should watch emerging inflationary pressures very carefully. Fiscal policy has already been expansionary, but as previous public investment targets have been undershot in many instances, accelerating this investment could provide one avenue for policy support if external conditions were to weaken further. Otherwise, fiscal policy should adopt eventually a more neutral policy stance. Policy priorities for the longer run include improving the monetary policy framework to foster stronger competition in the financial sector, which could in fact improve the allocation of capital and through that channel bolster growth. Finally, growth could become more sustainable by accelerating the rollout of renewable energy sources, given that currently most of Vietnam's electricity is generated from coal-fired power plants. Thank you.
Thank you very much, Jens. Now we're going to open up the floor to the questions from our audience. The first one we have is for Malaysia. We were surprised just a few hours ago by a new policy announcement from Donald Trump, the so-called revenge tax, an initiative that seeks to address what the US perceives as unfair fiscal practices by other countries. If Malaysia is subjected to this tax, if Malaysia is subjected to this tax, how significant would the impact be on the nation? And what measures can Malaysia take to shield itself from such a policy?
Well, I can start. I think what very important to say is that right now there's quite a lot of uncertainty regarding some of the policies, and some of the policies have had different announcements. So we usually don't comment on announcements anyway. But I think what matters is really for countries like Malaysia and other countries of the region to sit down and negotiate an agreement with the American authorities and the rest of the world as well, but in this case, the American authorities, to try to bring down trade barriers. And because what we clearly see is that obviously trade barriers have a significant impact on growth and prosperity of several countries, of all countries of the world, really. And so it's very important to sit down and negotiate. That's what I would say.
Maybe I can just complement that with a few thoughts specific to Malaysia. In principle, an additional trade barrier is no different from what we've already been factoring in to some extent. And here, I think the policy response should be exactly the same. In the sense, what can a country like Malaysia do? Well, Malaysia has some scope for support on the monetary side. Inflation is low and has been very well contained. But I think beyond that, it's even more important to think about structural policies that can augment the competitiveness of the economy going forward. Here, we mentioned the issue of skills mismatches, for example, investing more into education. That is certainly a way to make the economy more able to weather this and future storms that may come up on the horizon. In the same vein, thinking about additional improvements to the competition landscape, for example, by reducing remaining FDI restrictions, potentially also thinking about how one could create a more level playing field between state-owned enterprises, the GLCs in Malaysia, and the private sector, that would also be one way to boost competitive forces in the economy. So I think on those structural reforms, which are going to be very helpful for the economy in any ways, that there's a lot of scope to do more to be better able to weather these storms. Thank you.
Thank you. Our next question in the chat is about the Philippines. Given the OECD's 5.6 growth projection for the Philippines in 2025, below the government's 6 to 8% target, should the government consider revising its growth targets downwards this year?
Okay, so first let me say that we think that the 6 to 8% growth target for the Philippines is actually realistic in the medium term. Okay, so the Philippines has very strong demographic fundamentals, a young population which is still growing. Okay, so the working age population is still growing, which boost growth. Education levels in the Philippines are relatively high, as you saw in the slide presented by Jens, with very good tertiary education attainment, so a high share of the working age population that has a tertiary degree. We also see that the Philippines has a strong competitive advantage in services. So services exports are actually very strong, and the Philippines depends much less on goods exports, which are exposed to tariffs, than many other Southeast Asian countries. In part, that reflects very good language skills, English language skills, of course, and cultural affinities with the US. So we see a lot of strength of the Philippine economy, and especially if the reforms we mentioned before, especially liberalization of foreign investment and measures to boost competition are taken. But so in the medium term, 6 to 8%, we see that as perfectly attainable. But in the very short term, in 2025, 2026, we see 6 to 8% as difficult to reach, right? Growth in 2024 was 5.7%. Now in 2025, we have additional headwinds, especially from the external side, so a slowing of global trade, but also on the domestic side, where we see some fiscal consolidation going on over the next couple of years. So, 6 to 8% seems difficult to reach in 2025, 2026, but of course, never say never. Thank you.
Thank you. Now we have a question. How can Thailand improve its longer-term economic performance?
Hello. Yes, as I mentioned, I think in the second policy point, Thailand has scope to improve its long-run economic performance, in particular through strengthening productivity growth, that is the amount produced per employee. We see particular scope for Thailand to improve regulatory settings that will help its businesses become more competitive with each other. And the advantages of that, as I mentioned before, lie in not only the businesses competing and becoming more innovative and producing better quality goods and services, but also it helps make Thailand a more attractive place for foreign direct investment. We think that within this general theme of improving the strength of competition in Thailand, a number of themes. Firstly, there's a theme around the foreign policy towards foreign direct investment. Thailand, as do many countries, has various incentives for foreign direct investment, but also I think, as one of Jens's slides pointed out, there are various regulatory barriers. some of which could be eased and would improve Thailand's attractiveness as a place to invest. A second area that we're think where there's scope to improve policy lies in making Thailand's state-owned enterprises more efficient than they currently are. A third area lies in competition legislation, where we think there's scope to make some technical adjustments in that legislation that will actually make the competition legislation more effective. And finally, there's, as is the case for many countries, there is scope to work through various government regulations and laws, and to try and make sure that they do not hinder the operation of business. And so we think there's the scope to, if you like, reduce the amount of red tape faced by businesses, for instance, as regards processes to do with business licenses and permits and so on and so forth. So those are some of the key areas that we think would help to improve Thailand's productivity growth. Thank you.
Thank you. Another question for the Philippines. What do you think are the main downside risks for the Philippines' economic growth?
Okay, as I said before, the Philippines continues to show very solid growth momentum, supported by domestic demand and also somewhat by public investment. However, if there were to be a larger than expected slowdown in major economies, such as the US or China, that would of course have an effect on exports of the Philippines, and it might also impact remittance flows, which would then impact domestic consumption and investment. So let me just briefly say on remittance flows, there was a question on whether we take into account the possible tax on remittances by the US, and that is not taken into account in the projections, because we don't know, of course, whether that will be really implemented, and it is not entirely clear whether that will impact permanent residents or only temporary residents. So, this is not taken into account. Now that is negative risks, but of course there's also an upside to the projections. And what we see as the main upside is that the Philippines quickly implements reforms that are ongoing, especially to reduce barriers to foreign direct investment, which would then help to boost investment even in the relatively short term. Thank you.
Our next question is on Vietnam. Vietnam is still targeting a growth rate of above 8% this year. Given the country's high exposure to export-related risks, what are the possible pathways or strategies it could pursue to achieve this goal?
Okay, well, thanks for this question. I think one way, Vietnam has been growing very, very strongly, and our growth projections are still very strong. And of course, there's always a possibility to make this growth even stronger. And how could that be done? Well, I think one of the areas to consider among a number of them would be to look at how Vietnam has been able to reap the benefits from foreign direct investment inflows so far. So there's been a lot of FDI inflows. Much of that is very productive. In fact, it is much more productive than the domestic part of the economy. But there are relatively few interactions between that productive part of the economy and the rest of the economy. So particularly, there are relatively few supplier linkages between FDI firms and local suppliers. So how could that be improved? Well, it may have to do something with the quality standards that are demanded by FDI companies. That may be related to scarcity of skills in the domestic economy. So improving and investing into skills, into the accessibility of upper secondary and tertiary education, particularly where Vietnam is still doing weaker than other countries in the region. That would be one way. And here, Vietnam can build on its remarkable progress in lower secondary education, where its attainment is really remarkable, but carry that over into upper secondary and tertiary education. And then I think the issue of competition that was already mentioned can't be stressed often enough. It's very important to think about removing remaining restrictions, including to FDI and services sectors, thinking about a better and more even playing field between state-owned enterprises, which are sizable in Vietnam, and the private sector. Those are the general recipes that I would think could lead Vietnam to getting to even higher growth.
Okay, there's another question on Vietnam in the chat. Should Vietnam decrease the dependency on export in this trade war era? And what should be the new spearhead for this economy to grow?
Well, Vietnam has obviously grown very much on the base of exports, and that has been a very successful strategy. So decreasing the dependency on exports is easier said than done. I think what is the most important thing is to really improve the domestic conditions and undertake the structural reforms that it takes to become more competitive. And then there will always be space for Vietnamese exports and for strong growth when you get your policies right.
This question is about Indonesia. How is Indonesia positioned to navigate slowing global trade and China's weaker growth?
Okay, so the first thing to notice is that, as highlighted in Jens' presentation, Indonesia is a domestically focused economy. Okay, so growth is mainly driven by domestic demand, so domestic consumption and investment, with exports to the US, amounting to about 2% of GDP. So we don't expect Indonesia to be hit by the US tariffs particularly hard. But of course, Indonesia is going to be feeling the effects or the downside effects of lower external demand, right? So if the US slows and China slows as a consequence of the trade tensions, then that will have an impact on Indonesian exports more widely, especially through lower demand for commodities. So commodity prices are going to fall, and that would have a negative impact on Indonesian exports and growth.
Okay, and we have one last question for Indonesia. And it is the creation of Danam Terra a mistake in terms of boosting Indonesian growth?
Okay, so I'm not going to answer that question before 2 to 3 years. So you have to call me again in 2 or 3 years, then we're going to know whether it's a mistake. But just let me say that this new sovereign wealth fund fits into the Indonesian investment strategy by trying to crowd in private investment. And if it manages to crowd in private investment, then we would consider that in 2 to 3 years a success. So the very important thing here is that that actually governance of the fund becomes very transparent. And project selection is based on objective cost-benefit analysis. And if that is done, we see some potential for success of the fund going forward. Thank you.
Thank you. And with that, I would like to say that this session is closing. Thank you to all of our audience for your great questions, and we hope to see you again soon. Thank you.
Thank you.